In this video, I'm going to showcase a new indicator on TradingView that can be used to identify the trend, momentum, as well as divergence in the market. To add this indicator to your chart, you want to go to TradingView, which is the trading platform that I normally use. If you need to sign up, the link for that will be in the video description. Next, you want to load any trading security that you like in any time frame, and then open the indicator search tab. And then here, you're going to type in Modern Trend Identifier. And it's going to be this one created by Dude Owns. This indicator is made up of the following elements. We have the Arnaud Legoux Moving Average, also known as the ALMA, which is this line that changes color between red and green and traverses this indicator window. This is the main component of this indicator, and it's going to be used to track the trend as well as the momentum of the market. Next, we have these pink lines at the top and bottom of this indicator window. The one at the top is the positive RMS line. The one at the bottom is the negative RMS line. And then we have the upper consolidation threshold and the lower consolidation threshold. This red dot is the bearish divergence dot, and it's going to be used to indicate instances where there is a price divergence. And then we have the bullish divergence dot. This is going to be used to indicate instances on the price where there is a bullish divergence. This line in the center represents the zero line, and it's going to be used as the central axis point for this indicator's analysis. And then up at the top, we have this red dotted line, which is called the upper threshold, and it's located at the 80 point on this indicator scale. And then the opposite of this, which is the lower threshold, which is located at the minus 80 point on this indicator scale. We also have the plot backgrounds, which is just a color fill for the area between the Arnaud Legoux Moving Average and the positive and the negative RMS lines. Now, let's access the settings of this indicator so we can change some settings. On the Inputs tab, we want to change the upper threshold to 80 and the lower threshold to minus 80. Then scroll down here and change the upper consolidation threshold to 30 and the lower consolidation threshold to minus 30. And then on the Style tab, you want to scroll all the way down here and increase the opacity of the upper threshold to 100%. For the lower threshold, you want to do the same. Increase the opacity to 100%. After that, click OK. Now, let's go over how we can use this indicator to trade. The first method is using it as a trend indicator. And the way we're going to do that is by focusing on the Arnaud Legoux Moving Average, also known as the ALMA, which is this line that changes color between red and green. To identify a bullish trend, the ALMA needs to be colored green and above the zero level. Whenever this happens, you can look to take long positions. Conversely, for a bearish trend, the ALMA needs to be under the zero level and to be colored red. Whenever this happens, then and only then will you look to take short positions. Now, at this point in time, I know you may be thinking, but does this bullish crossover indicate a buy entry point, or this downward crossover indicate a sell entry point? Well, no. This indicator should not be used as an entry confirmation tool. It is only for trend confirmation, which means you will need other indicators for other confirmations, or you may even need to add some price action or smart money confluences to complement this indicator. For example, whenever the ALMA is above the zero level, this whole area indicates a bullish trend, but red levels like this can indicate pullbacks in the market. So whenever it switches to red briefly and then goes back to green, that would indicate a pullback in the market. And then you can combine that with other price action confluences or even other indicators to take a trade after this pullback. And the same thing for bearish trend. As long as the ALMA is under the zero level, it indicates a bearish trend. Green instances like this indicate a market pullback. Combine that with other confluences and maybe you may be able to take trades based on these pullbacks. Now, the second way of using this indicator is using it as a momentum indicator, and I'm gonna go over how we can do that in a bit. But for now, let's talk about the forex broker called HenkoTrade. I've been using HenkoTrade for quite some time. As you can see here, this is my live account on HenkoTrade's all-new trading platform called HenkoX. This is actually a new trading platform that they launched recently. It has improved functionality, fast execution, and overall better user interface. The reason why I love HenkoTrade so much is because of their low commissions and spreads. For those of us who love high leverage, well, HenkoTrade offers a maximum leverage of 1 to 500. If all of this isn't enough, they're also going to give you a 100% deposit bonus for all your first deposits of between $100 all the way to $25,000. So if you deposit, say, $500, they're going to give you a bonus of $500, giving you a total of $1,000 to trade with. To access the bonus as well as all the other perks, sign up to HankerTrade using the link in the video description. Now, back to the video. So how can we use this indicator for momentum trading? Well, we're going to be using the ALMA, this red-green line, and the upper and lower consolidation threshold. Whenever the ALMA is trapped in between these two yellow lines, that indicates a low or a lack of momentum in the market. Essentially, what that means is that the market might be consolidating. And as we can see here, that is exactly what was happening with this indicator. The ALMA was trapped in between these two lines, and looking at the chart, yes, it was consolidating. Now, after some time, the ALMA broke and closed above the upper threshold. Looking at the chart, the price was also breaking outside of the consolidation zone, indicating an increase in market momentum, which led the price to break outside of this consolidation zone. Combine that with other price action confluences or confluences from other indicators, and you may have a strategy to take trades as soon as the price break outside of these consolidation levels. The increase in momentum that happens just after these breakouts would increase the probability of the price heading straight to your take profit. Now, another way of using this indicator to trade is using it as a divergence indicator. Now, as mentioned earlier, these red and green dots are the divergence dots. They indicate bullish and bearish divergences. I'm not going to recommend using these for trading this indicator using divergences because they cover very short time windows. As you can see, for example, this dark green line is the one that indicates the divergence, and it only spans 3 candles. Instead, we're going to be looking at the price action ourselves to identify the divergences. But what is a divergence? Well, a divergence occurs when the price action is doing the opposite of what an oscillator is doing. For example, the price action could be creating a lower low, like right here. This is one low and this is another low that is lower than the previous low. But looking at the oscillator, we can see that the ALMA created a low right here, but the second low it created was actually higher. So we have a lower low corresponding to a higher low. This is a bullish divergence. If you had other confluences from other indicators or your own price action based strategy, you could take a long trade right here after the bullish divergence. Or maybe you saw that this was an engulfing candle right after, and then after the engulfing candle, you enter a long trade. And as you can see, that trade was super profitable. And of course, for a bearish divergence, it's going to be the opposite. Obviously, not all divergence entries are going to be profitable, so you have to combine it with other confluences to get profitability. Now, let's go over the fourth method of using this indicator to trade, which is using it to trade based on market volatility. So how do we confirm volatility in the market? Well, for that, we're going to be using these indicator components. First, we have the positive and negative RMS lines, these pink lines, and then we have the ALMA as well as the 2 yellow lines. Now, whenever the 2 pink lines are sandwiched between these 2 horizontal lines, that indicates that the market has little to no volatility, which means that the market may be moving too slow due to a lack of trading activity. But as soon as these pink lines get outside of the yellow lines, like here, that may indicate that the volatility in the market is increasing, probably due to an increase in market participants. Now, to know the direction the market is headed due to high volatility, you can also combine that with the ALMA moving average, this red line. So as you can see here, the 2 RMS lines were outside of the yellow lines indicating high volatility, and then the ALMA broke and closed under the bottom RMS line. This indicates an increase in the number of sellers in the market. So even though the market is volatile, it's being driven by sellers. And as you can see, throughout this area where the RMS lines were outside the yellow lines, the market was moving with huge candles. And then right here, the RMS lines went back inside the 2 horizontal lines due to a lack of volatility in the market. And as you can see, the market was consolidating. And then right here, the pink lines broke outside the yellow lines. Looking at the chart, there was increased volatility signaled by these huge candles. So when using this indicator to trade, you want to take your long positions in areas where there is significant market volatility to push the price in the direction of your trade. You know, areas like here, or even here for short positions. Now, last but not least, we can also use this indicator to trade the mean reversion strategy. Now, what is mean reversion? Well, mean reversion basically refers to the tendency of the price coming back to the mean after an overextension. Mean basically means the average price. So once the price overextends too far to the downside, it tends to come back up, or at least to the average price, and vice versa for when it extends too far down. So we first of all want to activate two lines of this indicator, the upper threshold and the lower threshold, and then we identify an overbought or oversold instances in the price. The way we do that is whenever the RMS line goes above the upper threshold, which is located at the 80 point on this indicator scale, that would indicate that the market may be overbought or overextended to the upside, which may lead the price coming back down or at least back to the mean. So like here, that is exactly what happened. The ALMA went above the upper threshold. After this bearish engulfing candle, the price came back down. And then the opposite of that happened here. The ALMA dropped too far down and it went below the lower threshold, which is located at the minus 80 point on this indicator scale. This indicated that the market may be oversold. Looking at the price, there was significant downward movement. After some time, the market shot back up in an attempt to return to the average. This, ladies and gentlemen, is the basis of the mean reversion strategy. You identify an overextended market by having the ALMA go beyond these upper and lower thresholds. And then you add extra confluences from price action or smart money concepts or even from other indicators. And then you take your trades. Now, one way of adding extra confluences from other indicators would be to add another indicator like the PineTrades market beacon, which is an awesome buy and sell indicator like this. And then you do the same thing. You identify an oversold market, wait for the price to establish a swing high, wait for the break of that swing high to indicate a potential market structure shift, and then you wait for a long signal to be printed by the PineTrades market beacon. With those three confluences, it immensely increases the probability of a particular trade turning out profitable. Now remember, the PineTrades market beacon is a private indicator, so to get access to it, you want to click on this link down in the video description, which is going to take you to this page where you're going to get a 30% discount as well as a 14-day money-back guarantee. So you're going to have all the time in the world to test out this indicator. And if you love it, you can keep your subscription, so use the link. Go ahead and try out this indicator and see what other strategies you can come up with. If you find a way to use this indicator in your own strategy, be sure to let us know. Well, that's been it for this video. I hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching. See you next time.